Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough. This is for exercise 1512. This is from the textbook Intermediate Accounting 17th edition by Don Kiso, Jerry Weingan, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, let's get it started. So right over here, cash dividend and liquidating dividend. So for Latoya Davis Corporation has 10 million shares of common stock issued and outstanding. On June 1st, the board of directors voted an 80-cent per share cash dividend to stockholders of records on June 14th, payable on June 30th. So when we have a dividend, what happens? Well, the chief financial officer and the chief executive officer, they're going to prepare a presentation for the board of directors. Okay, there may not be a board, but there generally will be a board of directors. Every corporation has one. And they'll essentially say, well, we have enough cash on hand, and we'll show them a projection to go ahead and pay this dividend. So what happens is the board adopts the resolution, and then the corporation declares the dividend. So we have a date of declaration. Okay, and then that's basically the date that we're going to go ahead and record the liability. There is a date of record. For the date of record, there is going to be no entry. The date of record is somebody, what we call the company's transfer agent. The transfer agent of the company essentially looks at who owns the shares on a particular date, and then they're going to be the ones who are going to do the record keeping. So there's a date of record. That's who actually physically owns the shares, or who has the ownership of the shares. They're going to be entitled to the dividend payment. Then we're going to have date of payment, which will also be making a journal entry. So right over here, what we're going to want to look at is we're going to look at the shares outstanding. So we have 10 million shares outstanding. So we've got 10 million shares outstanding. My dividend per share amount, and again, we're going to do this based on shares outstanding, not shares issued. So right over here, I've got 80 cents per share cash dividend. So this is going to give us a total right over here of $8 million. So the way we would go ahead, if it's that's the amount of the dividend. If this right over here was a distribution of earnings, what I would do is I would say, okay, on the date of declaration. So I would say over here, dividends, crediting dividends payable. And this would be for the $8 million. Okay. On 6/14/X1, no entry. On 6/30/X1, the date of payment, I'm going to be debiting dividends payable for this 8 million, and then I'm going to be going ahead and crediting cash for the actual payment of that dividend. So again, if it is a distribution of earnings, we're going to have debit to dividends, credit to dividends payable, debit to dividends payable, credit to cash. What happens with dividends? Well, just like all the other temporary accounts, we will ultimately close that out to retained earnings. So if you look at your textbook solutions, the textbook solutions may come out and say, oh, debit retain earnings. In fact, that's what they do. But ultimately, when we close out the financial statements, this dividends will get closed to retained earnings. So it essentially has the same effect. Okay, so if this was a liquidating dividend, what's the difference? The liquidating dividend is on a return on capital, which is essentially like what letter A is, but this would be a return of capital. So what you would do is, instead of debiting dividends, if it was a liquidating dividend, you would be debiting additional paid in capital common stock. So That's how that would be the only difference between the two. So that was a quick one, a good one. And I want to thank Wiley for allowing me to go through and to make these videos. Please don't forget to like and subscribe. If you're looking for other solutions, please feel free to ask for them in the comments. Have a great day.